You're browsing online, you find something you like, but you don't have the money, at least right now. In the past, you had two choices. You either practice self-control, save up and then buy it, or you put it on a credit card. The catch though is that credit cards can come with strings. Think interest, late payments, and overspending. Credit cards are great tools, but not for everyone. What if I told you though that you could still buy what you want, but you don't have to worry about interest? What if you could buy now but pay later? This trend has led to a booming industry that's expected to keep growing by 24.3% per year, at least in the US. Globally, you're seeing a similar trend with even more growth, north of 25% per year. There are growing fears on the products being financed, for example burritos or McDonald's orders. Today we'll look at how we got here, potential red flags, and why a lot of people are concerned. Big favor before we dive into everything is to give this a thumbs up to help with the algorithm. If you like these financial deep dives, then consider subscribing. Right off the bat, buy now pay later is not a new idea. The first iteration of this was pioneered by a sewing company. So back in the 1850s, sewing machines were going for about $125, which is about $3,500 in today's money. Back then though, people only made about $500 per year, so about $42 a month. This wasn't a frivolous purchase. It meant that you could not only repair your own clothes, but even make your own clothes and potentially make money from your work. Still though, 3 months of salary, not counting your living expenses and eating, is a lot of money. Edward Clark, their legal and business mastermind, had a radical idea. Instead of paying for the whole purchase outright, you can pay $1 down and then $1 a week. This tactic worked wonders. It didn't just make sewing machines more affordable, it actually tripled Singer's sales within a year. Suddenly, Singers weren't just for factories or for the wealthy, it became something that the middle class could afford. The strategy expanded everywhere and to other products. Fast forward to the late 1800s and early 1900s, you could do this for appliances, furniture, pianos, radios, and even cars. Money's flowing. Brands started mass advertising this, there was a growth of financing companies, and credit doubled from 1920 to 1929. In 1929 though, Black Thursday happened. So this was a stock market crash where billions of dollars in value was erased. It also started the Great Depression. Installment credit granted fell by 76%, and there was a wide wave of defaults, and sales dropped. Banks weren't lending, shoppers didn't want debt anymore, but shops still needed sales. This led to V2 of the space, which was layaway. So you put 10 or 20% down as a deposit, that way you hold it and that's yours. You then sign an agreement that spells out the terms. Once the balance hits zero, so once you fully pay off the item, then you get the good. This lasted a good 20 years from 1930 to about 1950. Only in the 50s, in the post-war boom with rising incomes, did we see the next wave of finance, which was credit cards. And to be fair, layaway did come back in kind of a V2 sense with the Great Recession. So between 2008 and 2012, especially with brands like Walmart and Kmart. Right after that is the start of the modern buy now pay later movement. In the US, Affirm was the main company to pave the road. So they started back in 2012, about 13 years ago. Maybe showing my age, but I associate Affirm with mattresses. And if anything, that was their product fit moment. The 2010s was the decade of D2C, direct-to-consumer, and especially mattresses. Casper being one of the biggest players to disrupt the space and the traditional process and made it possible to buy online. With Casper booming, we saw the start of the mattress wars, with probably 20 competitors joining the space, all going after different angles. So before this, Affirm's ticket sizing was pretty small. This moved the needle. $0 down and as low as $50 a month made it a win-win. The reason being that both sides got something out of it. The mattress companies operate off pretty amazing margins, around 50%. Affirm's fee was only 4 to 6%, so if it got them a sale that they wouldn't have otherwise gotten them, the net result was positive. Affirm also got value. As a fintech, they're measured off different things, but key ones being lending volume and defaults. They ended up getting relatively low risk volume and allowed them to fundraise more and keep growing. The other big catalyst was Pelotons. So instead of paying $2,000 upfront for a bike, you'd pay no interest, pay nothing upfront, and just pay $40 to $70 a month. Same idea as mattresses, Peloton's getting a sale that they otherwise wouldn't get, and Affirm is getting low risk and high volume. Okay, so how high was this volume? At the time of their IPO, 1/3 of their revenue came from Peloton. This early iteration makes a ton of sense to me, and it feels relatively safe. It's pretty much a win-win-win for the company, the fintech, and the person. In the past few years though, the space has evolved. So instead of just being big purchases, we're seeing experiences. Especially post-shutdowns, people have wanted to do more traveling, so vacations, and also concerts and events. This has led to a boom in credit card points and miles for some, and buy now pay later for others. Hotels and airlines are happy because it means more travelers and bookings. Fintechs still get their cut and you get your vacation. With this though, now comes more risk. Unlike a Peloton or even a gaming console, you don't really have a backup plan. So if a Peloton bike or any other equipment, there's still a market to sell it if you don't need it anymore or if you can't afford it. Even something that might be deprecated like a Nintendo Switch still has residual value. With a vacation or concert, there's nothing you can sell. Beyond this, we're also seeing this become the ordinary tool for food, contact lenses, and even trash bags. The most egregious of which is probably burritos. DoorDash partners with a lot of the providers. So there's restaurants, you have DoorDash, and the BNPL provider. You end up getting a burrito, restaurant gets a sale, DoorDash gets a sale and also their spread, and BNPL gets a spread. In theory, and it feels kind of wrong, it's still technically a win-win-win-win situation. Everyone here is coming out ahead, they are paying a fee or spread, but they're also unlocking a sale that otherwise wouldn't have happened, so the net result is better. The only cost here seems to be the risk. And to be fair, this is a pretty big one and it can add up, with over 100 million users, with Klarna having defaulted on these burrito loans. A lot of this is a function of math. BNPL providers generally make about 4 to 6% in fees from the merchant, so that's their spread. Assuming all the loan sizes are about the same, if they can keep defaults below 4%, then they're winning. If they don't want that risk themselves, they can also de-risk with Wall Street. Wall Street likes financial vehicles and enter burrito loans, also known as takeout bonds or even nachos, non-amortizing culinary holding obligations. There's a lot of private credit funds looking to buy these. The question I have on my radar is whether BNPL is the greatest financial instrument out there or the start of the next financial crash. On a related note, if you're looking for a new brokerage, Moomoo has a pretty good welcome bonus. You get between $20 and $1,000 in NVIDIA stock, depending on how much you deposit. You also get 8.1% APY on uninvested cash for the first 3 months. There are terms to watch out for. For all the levels, you need to maintain assets for 60 days to get the bonus, but it feels pretty fair. The math isn't bad either. So for level 1, you're getting 20% and annualized, that's 203%. The other levels are more reasonable, but annualized are still pretty awesome, considering that the long-term average annualized return for the US stock market is about 6 to 10%. Also a reminder that this can be invested, so you're not just holding cash. You could easily make a deposit, invest in a small basket of stocks, let's say 3 to 10 positions, and get the best of both worlds of the equity exposure, but also the welcome bonus. Offer runs until end of the year. I'll leave a link down below if you're curious. Let's actually start with the counter argument. Buy now, pay later is just replacing credit cards, and it's the better alternative to it. If you're using a credit card optimally, you're buying things you need, getting 2% cash back, and then paying the balance in full at the end of the month. You could do exactly the same flow, but with BNPL. You forgo that 2%, but maybe that's immaterial to you, and instead of the end of the month, you end up doing the end of 4 months. In theory, the BNPL providers are just arbitraging and finding that audience that doesn't like credit cards. Even if you argue that transactions are around necessities like food, that still happens with credit cards. And if anything, that's a core multiplier and battleground for the issuers. The main problem with this argument, though, is who's actually using these products. On the credit card side, with some of the flagship ones, household income is pretty strong, nearly $500K a year, with 4.3 mil net worth. The people that make very competitive salaries tend to go towards these travel credit cards because it's an easy arbitrage for their spend. If you make $200K and you eat out anyways, why not get an extra 2 to 4% back for pretty much nothing? That's not to say that they don't use BNPL, but it might be for those big purchases like the beds or Pelotons rather than food. If anything, they seem to be different rails and different audiences. With that said, I think there are 3 risk factors that might cause the buy now pay later space to pop. So the fear is that we're seeing only a small bit of it and that there's a big iceberg. Number 1 is the users. The CFPB, Consumer Financial Protection Bureau, did a report on this at the start of the year. Buy now pay later users hold more unsecured consumer debt than consumers who don't use BNPL. This is true even if you control for age, credit score, and seasonality. On top of this, BNPL users have $871 more in open credit card balances and also more in other debts. There's a very high correlation between use of BNPL services and other debts above and beyond what you'd probably expect. Unsurprisingly, there's also a correlation with credit scores. 46.8% of heavy BNPL users are deep subprime, so almost half. 17.6% are subprime and 12.7% are near prime. This is counter to the argument that it's just people who don't have credit scores, who don't like traditional credit, who are using these services. No score only accounts for 3.6%. That means that 77.1% of heavy users have below a prime score. Prime and super prime still use these services, but they're definitely not in the majority. Looking at defaults for heavy users, deep subprime is the biggest group with 2.1%, and then with occasional users, same thing, 6.8%. Like we mentioned earlier, the BNPL providers make between 4 to 6%, so they want to stay below that 4%. The question we have to ask is whether we're near pushing towards that number. Ages unsurprisingly skew younger, with 25 to 33 being the largest demo at 32%. The next group though is 34 to 40 at 21%, and then 41 to 50 at 20.3%. Interestingly enough, it doesn't seem like credit cards are even getting replaced by BNPL users because utilization rates actually increase since they first used BNPLs. Generally speaking, this is a sign of debt seeking. So for example, let's say you make money, but your current cash flow can't sustain your current costs. If this is their current credit card utilization rate, and then they add BNPL and it goes up, it kind of tells you something. When you add in more debt vehicles, the question becomes whether there's a bubble. I know BNPL providers don't like to call it debt, and they call it installment loans, but it's still functionally debt. BNPL use is highly correlated with other debts and other loans. So for example, heavy and occasional users have more personal loans and also retail loans. Also significantly more student loans. The counter argument is that BNPL loans are significantly smaller. It's not like a house or mortgage, which is a few $100,000 or $1 million. We're talking about 25 to maybe 500 on food. In order for a bubble to pop and for it to be substantial and affect other things, it needs to be big enough. On top of this, you would also need a pretty significant catalyst event such that people couldn't make money elsewhere, which in the current environment seems pretty tough, if not impossible. So for example, even if you lose your job, you can still do Instacart or drive for Uber or do a lot of other shared economy things. That pretty much means that we would need to have an economic shutdown such that you can't do those things, or Uber becomes obsolete. First one being a black swan event, and even then, we might not shut down, and second one is going to take time. So yes, companies like Waymo exist in San Francisco and some other cities, but it's still not all cities. I guess another potential one would be a market crash. If investments fall, people spend less, and there's less demand for these services. Even then, I think it would have to be a black swan event rather than a slight pullback. So think Great Depression or Great Recession. But yeah, main idea, I think we would need to see a pretty big credit crash, and for that to happen, there would need to be something else. The third factor that's probably underappreciated is a funding squeeze. So a big reason why all of this works is due to capital. Right now, the fintechs don't want to hold the debt and they're selling it off. Investors chase yield though, and if something else pumps like crypto, then maybe they reallocate. In that case, buy now pay later providers might have to rely more on other capital means, and the cost can go up. So for example, even if they house the loans themselves, they either need to write it off their book or they need to find counterparties to finance it. We're not in a zero interest rate environment, so there are a lot of yield opportunities and cost of capital increases, making it more expensive. That pretty much means that they would either need to charge merchants more, which kind of changes the economics and equation and everything, or they have less wiggle room with defaults. So before we mentioned how they're making 4 to 6%, but with that 4% even, there's still other costs and other servicing. In reality, that 4% they're making might be 3 or 2% after all the other costs. If cost of capital goes up, then that pushes against that and it makes it tough. And in that case, I wouldn't be surprised if we see one of these companies go out of business. I think we are still pretty far away from that, and I don't see it happening anytime soon, but it definitely is a risk factor and something to consider. Also consider that stuff like this has happened in other spaces that have been considered more safe, like mortgages. Main takeaway, the bubble's still growing, music's still going, and people are making money. Will the music eventually stop? Maybe, but for now, it's hard to bet against it. Yeah, I think if you are financially responsible, you're better off getting a card. And pretty much what you see of Prime and Super Prime as well. On a side note, if you are someone that wants to learn about cards and you want to support the channel, we have links on the website, AskSebby.com, and also down below in the description box. Make sure the links are competitive, but otherwise, it's a huge way to support the channel, so thank you in advance. If you made it to this point, leave bubble emojis in the comments down below, and I'll try to heart it and also respond. 3 questions. Number 1, do you use BNPL, and if so, for what? Number 2, are you concerned about the bubble, and if so, which purchases? Number 3, what do you think would be the catalyst event that causes everything to crash? And to be fair, ideally that doesn't happen, but that's always a concern in the back of my head. Big favor, thumbs up, share this, but otherwise hope you liked it. See you next time.